What's up, guys? This is Casey and welcome back to the channel. So if you all clicked on this video, it's because you guys are trying to understand more information about mortgages. And today we're going to be reviewing the top mortgage terms, and then we're going to be discussing some of the things to look out for from beginning to end regarding the entire mortgage process when you're trying to get a loan. So to give you guys some quick background, I've gone through multiple mortgages in the past. Recently went through one a year ago through different mortgage companies, and I can give you guys the full details on what to do. So without further ado, let's hop into this. So we're going to start by kicking this video off with going over the mortgage terms, and then I'm going to start walking you guys through the process of the mortgage, what to look out for, and what they're looking for from a closing perspective, underwriter, stuff like that. So these are the top mortgage terms that people or need to understand when it comes to buying a mortgage. So the first thing that I want to go over with you guys are the top things that people are not aware of, at least 40% of the respondents. The top terms, there's 6 of them that people are not that solid on, and that's the down payment, closing cost, APR, which is the annual percentage rate, the escrow, the earnest money deposit, and amortization. So first things first, with the down payment, it's kind of self-explanatory, but basically when you're going through getting a mortgage, specifically like if you're, well, actually whether or not you are a commercial, whether or not you're a first-time home buyer, you have to put down a certain down payment on the home to get a mortgage. So if you are a first-time home buyer, that's typically 3.5% that you have to put down. Sometimes with the second home, you may have to put down up to 20% or 25% if it's considered to be a commercial loan or a secondary investment property loan. They will require 20 to 25%. But for the most part, down payment is what you have to put down, that the mortgage company requires you to in order for you to qualify for a loan. So if you get a $300,000 house or $250,000 house, expect to put 3.5% down that you have to come to the closing with for the check. So that's what that is. Closing cost. Now, closing costs are a little bit tricky, and the reason closing costs are a little bit tricky is because most mortgage companies are going to have generally the same closing cost, but for the most part, these are the fees that you have to pay the mortgage company in order to close on the loan. And I would say outside of the deposit that you put down, the closing cost can be anywhere from like up to 6%. I generally find that it's actually realistically 2% for most loans. So let's say if you have a $300,000 house, a mortgage, I should say, loan that you're looking to get, you're going to expect to put down anywhere from say $6,000 to $8,000 in closing costs. So this is a quick breakdown of just what some of the closing cost fees are. Don't be overwhelmed by this. Just to know, if you don't remember anything else, the 2% roughly is going to be what you have to pay for closing costs. But some of them are loan origination fees. Most mortgage companies charge this. This can be negotiated. You can just say, hey, I don't want to pay it or whatnot. Or can you lower it $300-400? More than likely they won't, or sometimes they will. Some mortgage companies charge a percentage. Some charge a flat fee. Don't overwhelm yourself for too much of this, but just know the closing cost is what you're gonna it's what you're gonna have to pay at closing. Services, you can shop for appraisal fee, credit report fee, flood certification. Kind of self-explanatory. An appraisal fee is what they will pay to make sure that the home is actually valued at what they believe it's going to be valued at. Credit report fee, self-explanatory. Flood certification fee is to see if you're in a flood zone or whatnot. Services you can shop for as well here. That's what you cannot shop for. Let me also tell you guys with the appraisal fee, a lot of this stuff is just pretty much standard. Even though they say you can shop for them, you really aren't. 99% of the time, when it comes to closing costs, you're going to just basically pay whatever it is that's basically in there. So title search, title lending fee, home inspection, survey fee to survey the land, attorney closing costs, settlement fees. I don't think I actually ever paid this in any of my closing costs. Like I said, some charges, some don't. But what you will expect to be able to pay is, again, roughly 2% of it. So when you guys get a breakdown, when you go to actually close, they're going to give you a closing disclosure statement, and then there's going to have a breakdown of the closing fees. I mean, it is what it is. The majority of the time, people are going to look at it and they're going to say, okay, got it, and then, you're going to just sign it. Of all of these, the biggest fees that you're going to have is when it comes to closing costs, they require that you pay 12 months in advance of homeowners insurance. This is something that Actually, I wanted to talk about the end of the video, but because it's in the closing cost disclaimer, and that's the second thing we're going over, I just want to discuss it. So, homeowners insurance is something that you have to pay if you have a home in case something happens, like a flood or damage or destruction, whatever it may be, right? So you're gonna always have to pay 12 months in advance, and then a lot of mortgage companies require you to pay 12 months plus two. So you pay 12 months plus an additional 2 months of homeowners insurance, which you see is down here as part of your escrow. Now, escrow is something that happens that when it comes to paying your mortgage on a monthly basis, you have escrow. Your escrow covers your taxes and it covers your homeowner's insurance. Now, why do you have escrow? It used to be to where you did not have to pay escrow, meaning whatever your mortgage was minus the taxes and the homeowner's insurance, you just paid that separate. But what happened was that a lot of homeowners were defaulting on their mortgages. And so now most mortgage companies just roll it into it. And so to give people buffer, they require that you pay 12 months in advance. Again, it's not something extra, especially that you have to do, but just know that that's something you're going to have to incur on it. So I don't want to go too detailed on this. I've already felt like I've talked enough about it, but just know you have closing costs, 2 to 3%, yada, yada, yada. All right. So some of the additional things, APR. So the APR is the annual percentage rate that you're going to pay in order to borrow the money. So right now, depending on what the rates are, it's anywhere from like 3.5%. If you have great credit to, 4.5%, 5% sometimes. Now, they do have something called an ARM. An ARM is basically, it's an adjustable rate mortgage to where they give you like a teaser rate to be able to get you into the mortgage. Never, ever, ever take an ARM. So the problem with an ARM is that it's a teaser rate for 2 to 3 or 4 years. I can't tell you guys how many people I know that have lost their home because they took an ARM and they didn't completely understand that when the ARM expired and they came time to having to pay the regular rate, that their mortgage went up like sometimes up to $1,000 additional. So it's really for people who, my experience, couldn't afford the home in the first place. Now, some lenders would tell you that it's really just something to take advantage of the federal rate, and then you can always just try to refinance later. But I just find that if you have to get an ARM, stay away from it. You want to make sure you get a flat interest rate, so that way there's no games that get paid. Excuse me. So APR is annual percentage rate. That's what you pay, 3.5%, 4.5%, yada yada yada. Escrow we've kind of already touched on. The escrow is what you have to pay for your mortgage that goes towards your taxes and goes towards your homeowner's insurance and also your PMI. So the escrow is rolled into your mortgage. It's not something additional you have to set up. It's not something special you have to go and call around and get things done. Whenever you go through a mortgage company, they roll it all into an escrow automatically. So if it's Wells Fargo, Bank of America, when you sign on the dotted line at closing, they pretty much already set it up for you automatically to where if your mortgage is $1,700, $1,800, $2,000, whatever it is, $2,400, that they break down and show you how much your escrow is. They break down the 12 months that you paid in advance that goes in the escrow for your homeowner's insurance. They break down the taxes that they estimate that you're going to have to pay based on the last year's tax assessment of the home. And they break down what you're going to have to pay for PMI. Now, PMI, if you guys are not familiar with, it's private mortgage insurance. Quite frankly, I think it's ridiculous that we have to pay it, but they do, and we do. And what it basically is that if you put down less than 20%, then they require private mortgage insurance, which basically covers the mortgage company if you default. It's not for your benefit at all. It's purely for the mortgage company. So it's like, hey, we lent you the money. You put down less 20%, so we think you're a higher risk, and so therefore you may have to pay more. And so they require you to do that. So I think it's silly because heaven forbid if you do default on your mortgage, I mean, the risk is they come get your home. So I don't know why they do that, but they do. So yeah, you got to pay PMI on that. Let's see here. What do we got? We got the escrow, earnest money deposit. So earnest money deposit is what you pay when you initially want to submit an offer on a home. So some some sellers, if you're buying a used home, right, that's not a new home, will require you to put down like $1,000 or $1,500 or sometimes $500. So typically earnest money deposit is a percent of whatever the value of the house is. So if it's $300,000 house, it's $3,000. But I generally find that most homeowners, if you just put down $1,000 is sufficient. Now, when it comes to new homes or new builds, Typically, it's anywhere from $500 to $1,000, depending on where you're purchasing and what city and whatnot. But just know that when it comes to submitting an offer in a home, whether it's a used home or whether it's a brand new building where you're just, agreeing to buy it, you will always put earnest money deposit down. I've purchased multiple homes, and I have always had to put down $1,000, almost exact on all of the homes. So that's what you have to do. Amortization. Amortization is a really, really big one. And the reason this is a really big one is because the amortization is the breakdown of how much money you pay in principal and how much money you pay in interest over a monthly basis. So let me show you guys something that I promise you, if you guys have gotten this far, it's about to get really good here. When it comes to amortization, right? Let's say here you have a house, $300,000, 30-year loan, 6% interest rate, which isn't even what the rates are right now, but let's just say 6%, right? If you take a look here, right, your beginning balance is $300,000, and this obviously doesn't factor in the fact that you put your deposit down or whatnot in earnest money. Oh, that's also something that I left out as well. Your earnest money does go towards the value of the home, so it doesn't get kept. They don't put it in their pocket. It goes towards the price of your house. Let's take a look here. In the first year, right, you will have paid $17,000. You will have paid $17,000 in interest. How that breaks down to is $300,000 the beginning balance, $1,500 in interest, $298.65 in the first month, and then every single month you will see that slowly the principal that goes towards the actual balance goes up and up and up. This is why when you get a mortgage, you will pay the mortgage here. Take a look here, $647,000, right? You will have actually paid twice the price of the house at this time that you finance only $300,000 if you're just making the regular payments. And that's because they front load the interest. So your first payment, $1,500 of your $1,700 literally just gets set on fire. They just take it, put it in their pocket. It's pure profit. And then $300 of it, right, goes towards your principal. So next month you got $701. So the amortization table is literally how the breakdown goes of how much the interest and the principal fluctuates and increases and decreases over time. Now, if you guys are wondering, well, damn, how many payments do I have to make before just more money starts going towards principal than even interest? And you gotta go all the way down, all the way down, all the way down. That kicks in your 223rd payment. Now, I'm going to tell you guys a secret here that a lot of people will not tell you, but I am telling you. And if you've watched this video and you've gotten this far, consider yourself lucky. If you make an additional $100 on your mortgage payment, right? $100 on your mortgage payment every month, you can knock down up to 6 years in interest, literally within the first 2 years. And it just has to do because the way that the amortization table works, you're breaking down the balance faster, but it only works in the first couple of years. So you want to make sure that if you are getting a mortgage, that you're doing it very aggressively. My rule of thumb is to pay an additional an additional payment once every quarter if I can. So every 3 months to try to pay an additional payment if you can. If not, it's totally understandable. Just do an extra $100, which equals out to basically, a little bit less than a mortgage payment per year, and you will knock down significant years off the back end of the loan. So that's something to look into. So that's what a amortization table looks for. So let's kind of go through really quickly the rest of the terms to look out for, right? And let's just address it from there. Now, they say here that 70% of people don't know amortization. Well, you're not that anymore if you've watched this video. Earnest money deposit, we've gone over that. Escrow, we've discussed that. APR, we've discussed that. Closing costs, we've discussed that. And down payment. One of the things I also want to discuss with you guys with APR is there is your interest rate and then there's the APR. They are essentially the same thing. The only difference is that the APR covers what you will pay in addition to the closing costs and so forth. Like it rolls up all the fees that you have to pay. So typically let's say interest rate is 5.8%. Your APR might be 6%. So it's always a little bit higher, but it's insignificant in the grand scheme of things. It's just a different term that they apply. One factors in the closing cost, the other one doesn't. So Let's go down real quick. Some of the things, all of the terms, so you guys are well aware of it. Then I'll give you guys some additional things to look out for from the common, what they look for in terms of approving you for a loan. Appraisal amount is pretty much what you have to pay to get the house appraised. So that's almost standard. So if you go and you want to get a house, an appraisal takes place. It's usually anywhere from $300 to $600 just to show the value of the house is what they are giving the money for. You do always have an appraisal that gets done also, even on new builds, but that's what that is. It's standard. You're going to pay it. Assets are anything that you have that shows what your liquidity is or what your value is, right? Your net worth. So bonds, stocks, CDs, 401ks, checkings, and so forth. Most people, it's going to be the 401k or the checkings or the savings, or maybe some additional properties if you have any of that. But it's just, your assets. They factor that in. A balloon loan payment. I almost never see this. I'm sure they exist, but I've yet to encounter one. And a balloon loan payment is when you basically have to pay a very, very large payment at the end of the term in order to actually finish paying off the mortgage. And typically people do this is to keep their monthly payment down, but I've yet to see this. I think some mortgage companies still do it, but it's not standard at all in the slightest. So, they give out different balloons, different payment types with you paying interest only and so forth. But I haven't seen it and I wouldn't worry about it. Just so in case you're wondering, I would never get a loan with the balloon payment because that's a great way to lose your house or your property. Closing costs, we've discussed it already. Closing disclosure. Again, this is what they give you at the, actually before closing. They send it to you via email or something that just breaks down what your closing costs are. They will have you sign something beforehand online that says, hey, do you want to forego the 3-day review that's legally required before you get your closing disclosure relative to close. So it's, in other words, they have to send you the closing disclosure at least 3 days before closing, so you have time to review it and ask questions and stuff like that. Because I guess in the past, companies tried to play games with fluffing the closing costs, and then by the time you didn't have enough time to ask questions, then you had to just be, had to be forced to close on it. So I've always waived it, but I've usually purchased new builds. But you have that option to to choose it, not to choose it. I don't think it's a big deal. Now this is a really, really, really big one. This is a huge one. Your D to I. Your debt to income ratio is what you owe with all your debt, your credit card bills, your student loans. Some mortgage companies factor in student loans, some don't. As a matter of fact, I think most don't, but some will. Your car loan, anything. Your ratio with that to your gross income. So if you have $10,000, I'm just using a crazy number, $10,000 a month, and you have $4,000 in like credit card, $4,000 in credit card debt and rent, and I don't know, anything else that you would have on your credit report. They take that and say, okay, well, you have a 40% debt to income ratio. Banks do not want to lend to anyone that has a higher than 50% debt to income ratio. So typically what they'll do is just say if you're like 54%, 55, they'll say, okay, well, hey, you got 3 cars or 2 cars, you got to sell that car to get your debt to income ratio down. And they won't say you have to sell your car. They'll just say you have to get your debt to income down, or perhaps some credit cards or something to where your debt to income ratio is below a certain amount. This is a really, really big one. And this is probably one of the biggest ones that get people caught up when it comes to getting mortgages, is they have a high debt to income, got a bunch of debt, a bunch of credit card stuff, and you don't have enough, make enough to have at least a less than 50%. So then mortgage companies don't want to approve you. So if everything on here, if you don't remember anything else, this is a really, really, really big one. Know what your DDI is, and 50% is really the industry standard. So gotta always get that down. Know what it is. Check out your credit report. Get it done. Deed. The deed is what you pay and what gets sent to the county registrar, right? For who, it's basically that shows who owns the property. So it's a document that gets presented to the county of where you're to where you live, right, or the home that you're purchasing on the property. It shows who actually owns and has rights to the property. Discount points. One quick thing also with deed. What you will also notice is that when you get a mortgage, the mortgage company will be a lien holder on the deed. So the way that it works is that you are the technical owner of the home, but the lien holder will, if they were to look up public records, so once you close on the house, that gets registered with the county of wherever you're purchasing your home or your property. And it's public information, so anyone can look that up. You will see that it shows your name, shows when you closed, usually shows the amount. Some counties you can hide that information in terms of the price of the home that you paid for, but then you will see that there's a lien on the property from the mortgage company that you borrowed the money from. And there are different lien amounts. There's a primary lien and a secondary lien. And that just basically means that if, worst case, something ever happened to where the house ever went into foreclosure, or you ever walked away from the house or what have you, whoever gets first dibs are getting their money back. So first lien holders are typically the first mortgage people. And the second lien holders are typically if you went and got a second mortgage, or if you borrowed any money against the house and after already closing on the house the first time. Discount points. Discount points are what you can pay. You can literally pay additional money at closing in order to reduce the cost of your mortgage, of your interest rate. I have never done this. I've done the math on it, and I typically find that you end up paying more money, what you pay for the discount points, than if you actually had just went ahead and then just got the regular interest rate. So I typically do not pay additional points, and I would recommend that you guys don't either. So that's it's kind of important to not do that. Got my carrot notifications here popping up. I think my battery's probably getting low. Hopefully not. I had it charged up. New laptop, so it should be pretty good. Down payment we've kind of already gone over, right? So down payment you're gonna pay it. You just are. So this talks about if you get an investment property. Investment property says 20%. I've called around. I've talked to a lot of different investment companies. It is no longer 20%. It is 25%. Now, this is the second biggest thing you guys need to remember. If no one else, if you've gotten this far in the video, at this point, you got to give it a thumbs up. But guys, understand something here before I get too far off. I am trying to literally give you that game with mortgages. This is something that people do not do in the mortgage industry. The lenders, people who buy additional homes, none of it. They make it very intimidating. And so I am trying to literally give you guys everything that I've gone through. No games that's getting played, no stringing you along. I'm trying to just break it all down for you and simplify it. And also I'm trying to clarify a lot of the misconceptions that get put out there that are not in your benefit. When it comes to getting a house, you do not need 20% for first-time home buyers. I had a cousin here who's educated, degrees, makes good money. She didn't purchase a home for years because she's like, Casey, I was told I had to get 20%, and I don't have the 20% yet. I'm still trying to save up. You do not need 20%, and you've never needed it. So if you're looking to be a first-time home buyer, you need 3.5% you have to put down on the home. Now, there are some other, like FHA loans and whatnot. They have slightly different percentage down payment amounts. But mostly it is 3.5%, and that is what you have to put down. This 20% thing, and you keep reading this on all the different blog sites, you only have to put 20% down if it is an investment property. And realistically, in today's times, it's actually 25%. And I only know this just because I've been calling around trying to get investment loans. So it's 25%. But new homeowners, 3%, 3.5%, that's how it is. Earnest money, we've gone over it. Escrow, we discussed it. Fixed rate mortgage. Fixed rate mortgage is basically the opposite of an ARM. So you want to go, they run your credit, look at your D to odds. Okay, great. Based on this, here's what your rate's going to be. And that's it. And so you always want to get a fixed rate mortgage. Now, you'll find that some people who want to get really cute with borrowing money and think they know a lot of stuff, that they'll say, well, I always get an ARM and I just refinance because I pay. Hey, man, power to you, right? I never get ARMs, and I will never get ARMs. Fixed rate mortgages is the way to go. You get your best rate, you lock it in. You don't have to worry about any additional games that get played. You get paid over a 5 or 10 year period. What you pay per month is what you will continue to pay, unless, of course, you refinance after you've been paying off for a period of time or your house value goes up. So fixed rate mortgage is the way to go. Now, what you will find is that there are 15-year and 30-year mortgages. 15-year mortgages, you will always pay less interest because you are paying less. You're paying off the price of the house in half the time. And so what you'll find is that if you go to a amortization table, right? Look at this, $347,000 on a 30-year. If you did a 15-year, if my keyboard can, that's the other mortgage calculator here. Do a 15-year, calculate. Look at that, almost $200,000 less. So significant. Obviously, your payments have gone through the roof. But if you take a look here, right, now the game with the monthly schedule is drastically less. Remember how you were only paying like $200 the first month? Now look at that. Remember, we used like the 222nd payment. With a 15-year mortgage, you'll start paying more in principal on the 50th payment, 49th payment. So it's a hell of a lot better, but your mortgage payments are a hell of a lot higher, and you can afford less house. So that's just something to keep in mind out for. But in terms of the fixed rate mortgage, that's what it is. You got a fixed rate. It does not fluctuate. Home inspection, we've discussed. Homeowners insurance, we have discussed. But if you're not aware, you will always require homeowners insurance. Homeowners insurance is a big deal. You can never get out of it, nor should you ever want to. Again, homeowners insurance is what you pay on a monthly basis. It's written to the cost of your closing, almost always. And it's like $40, $50, $60 a month, sometimes a little bit more than that. And basically, it's just what you pay a third party automatically that covers you in case something happens to your house. So if your roof gets blown off, I just recently had hail damage on one of my houses, right? Just recently closed on a relatively new home and got hail damage like 8 months after closing. So had to get a new roof. A new roof was $20,000. I was paying homeowners insurance, and I was paying $70 a month. And so the insurance company paid for my new roof, $20,000. So you have to have it. You're legally required to have it, I believe, and you want it. Don't ever have a home and let your homeowner's insurance lapse. It's a big no-no. It's huge. Mortgage terms, we've already kind of gone over that. Pre-approval. So pre-approval letters, personally, I don't think they carry any weight at all. But it's just basically you go online to like a Rocket Mortgage, which, by the way, I'm going to be very clear here. This is not a sponsored video. I just randomly chose Rocket Mortgage just because it has all of the terms that I wanted to discuss. So I'm not affiliated with them in the slightest. But you go to like a Wells Fargo or Bank of America, whoever, right, and go online and try to apply for pre-approval based on your credit and whatever information you put in. They say, oh, yeah, okay, cool. Based on what you typed in, yeah, we'll give you pre-approval. Yeah. You're good to go. Take this letter, to show that to the buyers, because some buyers will say, well, we require pre-approval before we'll accept an offer. I typically don't find that to be the case. Now, what you guys will find is sometimes, what do we call those people? The ones who walk through the houses. I'm having a blank here right now. Real estate agents. There we go. Real estate agents, sometimes it's up to them. Will ask for you to have a pre-approval before they'll work with you, just to show that you're serious about wanting to get a home and not wasting their time. But pre-approval is just to show that you got the preliminary approval based on what you typed into a system. So I've never gotten a pre-approval letter before. I never had anyone ask for one. Never had a real estate agent ask for one. Some will ask for it, but it's not something that you usually have to provide. I would say 95%, 90% of real estate agents do not ask for a pre-approval letter. They just take you for your word because you're looking for a house. So, but I do see that this is becoming more and more prevalent. So just keep an eye out for that. Principal, we've kind of already talked about, but the principal is the amount that goes towards the actual balance itself. So $300,000, like we showed you with the 30-year mortgage, right? You go back to the amortization table here. The principal is what actually the part that pays off the mortgage. So this principal amount, so you have a $2,500 a month payment, $1,000 is principal, gets knocked off here. The rest goes towards interest, which is money into the mortgage company's pocket. PMI. We kind of already talked on that, but the PMI is 20%. The 20%. The PMI is what you have to pay when you get a house that you don't have 20% equity into it, or you're not putting 20% down. You will always have to pay PMI if you are putting less than 20% down, or if the house is worth less than 20% of what you're qualifying for. So if it's a $300,000 house and you find somebody's like, man, I gotta get out of this house. I just want to sell it tomorrow. I'll sell it to you for $240, right? That's 20% profit, 20%, equity having the house. You will not have to pay PMI. By the way, if you can do that, then you'll be rich in no time. If you can find that. But most of the time, $300,000 house, you get it for $295, $297. You have to pay PMI, which is usually about, I'd say about $100 that you'll find, usually depending on the cost of the house, 300,000, 270, pay about $100 in PMI, and that gets paid monthly, by the way. So that gets wrote into your monthly mortgage payment. Property taxes. Property taxes is a very tricky one. So this is the third thing that's super, super, super important. Property taxes. Now you got saying, well, property taxes gets rolled into my monthly payment. So what's the big deal? Now here is huge. I want to underline huge when it comes to property taxes, especially when it comes to new properties. Okay, if you guys have gotten this far, this is the third golden nugget that is super, super, super critical when it comes to getting a home mortgage. This right here might even be the biggest thing, and I'm gonna tell you guys why. What mortgage companies do, and this is specifically for new homes, okay, not existing homes that you're buying from a previous home buyer. For new homes, they'll get you these. A lot of times they'll waive closing cost, and they'll have lower the deposit you have to put down. And what they'll do is they have this thing called unimproved and improved property. So unimproved means, hey, actually, unimproved means that the house is not yet fully built. Improved means that it is fully built. So to give an example, every year, whatever county you live in, right, a tax assessor for the county goes out and they look at every individual house and they say, okay, great, house is still there, good condition, the taxes have gone up 2% this year. What happens with new builds is the tax assessor will go out while the house is still being built, which happens 99% of the time. It's happened on every single property that I've purchased. And they will say, okay, this house is unimproved. What that means is that when you go to close, you're not going to pay the full mortgage amount. You're going to pay the mortgage amount for only the price of the land, not the house. So how does that factor out? That means typically on a $300,000 house, the land itself is worth, like, say, give an example, $50,000. But the house, right, is worth $250,000, which gives you the $300,000. $50,000 on the land, $250,000 on the house. So what happens is, let's say you have a $300,000 house, the mortgage should be $1,900 a month. But when you go to close, because the house was still being built, you will actually start paying like $1,400 a month. So you should be paying $1,900 a month, but your mortgage will be $1,400 a month right out of the gate every single month. And the reason this is so important is because they do not tell you this. They will mention it to you, but they don't explain to you that when you go to close, you are paying your monthly mortgage payment on the unimproved amount. So let's say you started building the house in May. Hell, let's say you started whenever, right? They started building in the middle of the year, whenever. And the tax person goes up there and says, great, this is unimproved. This is what we value it at. Well, what will happen is the following year, right? A lot of the times they will keep charging you the unimproved amount even after the tax assessor goes out the following year. And then I'll give you guys an example. This happened to me 2 years ago. I had a loan with Wells Fargo. And I don't want to disparage companies, but Wells Fargo is notorious for this, and I'm just calling it like it is, right? I've had multiple mortgages with them. This is just what they do. And I also have spoken to people when I was renting apartments who lost their homes who have Wells Fargo mortgages. And by the way, Wells Fargo is the largest mortgage company in the country. So, I'm telling you guys based on my experience. All right, multiple experiences. And in addition to this, multiple people that have had Wells Fargo mortgages. You're closing the house, unimproved amount, $1,400. Let's say, say the tax assessor comes out in March, right? And you closing your house in June or July. So it's after when they've already closed out. Right? So you pay $14 a month. Cool. I'm balling. I got enough $500 in my pocket. Next year rolls around and March, tax assessor goes out, right? And it's okay, great. This house is now improved. So now we see the house is here. If house is valued at $300,000, now you need to be paying $1,900. What will happen is that you would think that the mortgage company would just send you a thing saying, hey, you now got to start paying this amount, but they don't. What they'll do is, at least what I've found, is that they actually wait a couple of years for you to be in a home paying the unimproved amount. Now imagine being in a home to where you should have been paying an additional $500 a month to cover your taxes, right? This is purely for your taxes. So again, the following year, so you've been in the home, just got the home. The next year rolls around, January 1st. As of January 1st, although the tax assessor hasn't come out yet, right, for that brand new year, the house is built because you're living in it. So it's going to be the improved amount. And then the tax assessor comes out in March, right, the following year. So, yep, house is here, you're living in it, everything's good. Cool, $900, which you're going to have to owe us for the whole year. It doesn't just start from when they do the tax assessments for the whole year, right? Now, the mortgage company should know that, and they should send you a letter saying, hey, man, you need, mortgage is going up for this year, but they don't. What they do is they'll cut the tax company a check for the difference of the $5,000 or $6,000, right? And then they'll just keep it on their books as saying, okay, well, you owe $6,000. And then you'll get a letter from them the following year, like in the middle of the next tax assessment. So damn near 2 years later, saying, hey, well, we paid the additional $500 last year per month. And then we paid the additional $500 for the next 3 months for this year. And so now you owe us $7,000 or you owe us $5,000. And if you can't pay us that, oh, no, I'm sorry, you owe us $5,000. And in addition to that, your mortgage is going up to $1,950 a month. And if you can't pay us the $5,000, then your mortgage is going for $2,200 a month. Thank you for banking with such and such. Have a good day. Oh, and this will be happening in the next 60 days or 45 days. I got a letter like that in the mail. And so be very, very, very mindful that if you are purchasing a brand new build, you want to pay the improved amount from day one. If they don't do that, then you need to make sure, if you do nothing else, that you take the additional amount of what it should be and you put that to the side. And you need to also make sure that you call the mortgage company the following year when the new year starts. You're like, hey, man, I need you to kick my mortgage up. Right? Or make sure you have it to the side, because if you don't, people will lose their houses the moment they get that letter. It's over. Got to sell your house. You lose your house. You lose your down payment. You lose all the extra. They take the house and put it back in the monopoly board. You lost it all. Property taxes is no joke, people. More people lose their home to property taxes than anything else. It is serious, serious business. And that is why I'm spending so much time on that particular thing, because it is huge. All right. So just know that, understand what your taxes are, and understand if you're getting a new build, whether you're paying the unimproved amount when you go to close or the improved amount. 99% of the time, it is the unimproved amount, which means that ain't your real mortgage amount. They're giving you a teaser rate, but they won't tell you that until like over a year later. And then by that time, they'll tell you that you owe them $7,000 in back interest payments to the mortgage company, and you need to pay the next 40 days, or your mortgage is now going up $800 a month. It happens, people, and they do it intentionally. And need to be lookout for it. Real estate agent says you'll be required to pay sorry, wrong one. That's the taxes. Real estate agent, local property professional. We all know what a real estate agent is. So the real estate game is changing when it comes to real estate agents, right? And the agents know this. I mean, it's just one of those things to where, you don't need an agent to buy a house. You don't need an agent to sell a house. You just don't. And they'll tell you that you got to pay 3% to the seller and to the buyer agent. The seller always pays, 99% of the time, the seller pays the agent commissions. I'm not paying an agent 3%. The game is changing. You can buy a house on Zillow. You can buy a house on Open Door. You can sell your own house. You can write up your own documents. I'm not paying someone 3%, of my home that I've paid interest on, right? That I've paid taxes on, that I have had to find the closing cost, that I've had to maintain, cut the grass on. I'm not paying somebody 3% of, and it's not even the profits of the house. It's the total value of the house. To me, that's insane. That's robbery. Okay. $300,000 house, you've been paying thousands of dollars of interest on, and then you have an agent that says, hey, you want to sell your house? Good, we'll help you sell it. Yeah. Just pay 6% of the total cost of the house. Well, hold on, man. What did you do? Couple documents here and there, show the house. Well, I'll show it myself. So that's just me. So negotiate your commissions, 2-3%. It is what it is, right? Refinance. Refinance is when you can go and you can, get a different mortgage. So typically people refinance their mortgages because either the rates have gotten better, or the credit has gotten better, or what will happen is let's say the price of the house has gone up significantly. And so they can refinance to get the PMI removed, or they can finance to get a better rate. Or sometimes if, let's say, a house has gone up significantly past 20%, let's say they got 30% equity. Well, sometimes they'll refinance to get a new mortgage. So the first mortgage gets paid off. They get a second mortgage to take out 10% of some of their profit. So refinance is just basically when you sell, the mortgage, a secondary mortgage company will buy or pay off your first mortgage to give you a different mortgage for whatever reason you want to accomplish. So to get a lower rate, money out, and what have you. Seller concessions. I don't find that sellers make a lot of concessions unless they really have to sell the house. Seller concessions could be closing cost amounts. Seller concessions could be, hey man, we'll give you some money back for closing with us. Seller concessions could be anything. It could be that we'll keep the refrigerator in the house. Keep in mind that when it comes to another really big thing, but not as huge, but still pretty important, when it comes time to buying or selling a home, existing home, you can make concessions on anything. You can say, hey, we'll buy your house, but we want you to keep the furniture. We want you to keep the refrigerator. We need you to redo the floors. We need you to fix the scratches, whatever it is. You can make concessions. Now, typically in a buyer's market, right, sellers will make more concessions because there's more houses to sell than buyers. So people really want to sell their house, they'll make concessions. In a seller's market, it's the opposite. It's less houses, more buyers. And so you may be making some buyer's concessions. They may say, hey, we need you to put more money down, or take it or leave it. Or sometimes you might have to pay over that amount. So there it is. Battery's low. Why is my battery low? I don't know why it's low. I guess it's low because I need to plug it up. Seller concessions, we've discussed it. Title, we've discussed that, right? So title is pretty much, the proof that you own the home. And that's going to go, and that gets registered with the county. So, they'll check, they'll say, okay, well, who owns the title to the house? And, it just shows legal ownership of the house. And every property has a title. Title insurance. Title insurance is what you're going to pay, right, to make sure that the title is free and clear. So in the closing costs, the title company, when you go to purchase a home, the mortgage company will go to a title company and say, hey, we need you to certify that this title on this house is clear, that there's no liens, there's nothing outstanding on the title of the house itself, so that we can put our lien on it, that there's no one else has dibs to this house. Usually it's like $1,000, $1,200 that they have to pay, or that you have to pay in closing costs to make sure that the house title is clear. Those are the top things to look out for. Now, when I'm going through my mortgages, the most important things to know is your D to I is huge. The next important thing to know is make sure that your taxes are straight, okay, particularly with new properties. And the third thing to know is that when it comes time to closing, they're going to probably ask you for any and everything. They're going to ask you for documents back and forth, things that you think you've already submitted, or they're going to ask you for more and more and more. But the important thing to do is just know that when you go into the closing process, don't go out and buy a new car. Don't go out and make some expensive purchases, because anything that puts you over your D to I limit, they could turn around the day before and say, we're now not going to qualify you for this loan. So you've been working on getting approval for 3 to 4 months by sending the mortgage company all these documents and going through the underwriter, going back and forth, just to be denied because you took out a new credit card and went spending a Saks Fifth $5,000. So those are the 3 things to look out for. Guys, I hope this video was very beneficial. I really did try to give you guys everything that I know when it comes down to this, to the markets, when it comes to the mortgages, to the process. I've given you guys what I know to look out for, and also what to look out for when it comes to the whole document stuff. So let me know what you guys think. If you've gone to the end of this video, that deserves a like. That deserves a thumbs up, I think. But just as important, I would love you guys' comments. Let me know what you guys thought about this video. Did you find it beneficial? Did you find it informative? Did I miss some things? There's some things you guys want me to elaborate more on. I really love the feedback, because it lets me know people are watching the video. It lets me know that people think that the content is good, and also lets me know where I can improve on. So I really appreciate it. Let me know what you guys think, and I will talk to you later. Thanks for watching. Take care.